Woohoo! Hey everybody, thank you all for being here. This is part 2 of the biggest beast we've ever created, and I just want to take a second to thank the team behind me, especially Dr. Watson, to make all this possible. This is a seminal study. I was asked also to turn up my mic a little bit. I don't know if I can do that. Anyway, I'll try to speak a little bit louder. So this channel, just a quick reminder everybody, it's all about math, money, freedom, helping others. We don't shill. We're not bought by anybody. We're completely independent, despite what some people may think. Anyway, we try help investors become better, stay away from bad investments, and try to focus on good ones. And the investment game is extremely difficult. But we're going to profile the legends that we believe are the legends, and we threw a few red herrings in there too. So it is a seminal study. Nobody's ever dug into this type of data before with this level of detail or anything like it. Not that we could find, and we've searched for years. And it probably is one of the most important videos you'll ever see on YouTube if you are an investor or an aspiring investor. And remember, I always say this, investing is a blood sport. For every winner, there's a loser. You need to sharpen your skills to win at this game. It is not easy. And a key to success in investing is knowing who you are. And this is a framework to help you do that. This is a story of how to build success in life, finding who you are, what your strengths are, what your weaknesses are, and shoring those up. And that's it. So let's go. After that big announcement, self-awareness is key, as Ray Dalio says, and we'll talk about it as we go forward. So part 2, what is the story so far? Here we're going to talk about the top investors we profiled, see who you are, most successful legends and their personality types, correlations between time series and winning, risk in winning, analytics and winning, focus in winning, where the legends fall in the archetypes that we built, personality types mapped to returns and key to success, and see if the research is in line with our 2021 thesis. And by the way, 14 months ago, I just started on YouTube, so nobody watched that video, so it doesn't matter. And what you can do if you are missing a trait. And we've included the analytics from nearly 3,000 respondents to the survey, and 3,000 people responded in like 18 hours. It was a huge response. So a big thank you, everybody. And we're going to do so much more with that information to help you all. So first of all, let's jump into the top investors profiled. First, again, we need to look at these so-called legends and why each one is different. Each one has a unique fingerprint. Each one invests in different things in different ways, in different times, different assets. So the point is, take a learning from this, find out what you're good at, what you enjoy, and follow your own chosen path to be like these legends. We also threw in a few red herrings for fun to not only test the data, but if you can spot any red herrings, please drop a comment below. Little quiz. So who we profiled? We profiled names like Bill Ackman, Bill Gross, Bill Miller, Bill Lipschutz, Carl Icahn, Cathie Wood, Chamath, Dan Loeb, George Soros, Jack Bogle, Jim Cramer, Jim Rogers, Jim Simons, Marc Lasry, Michael Burry, Paul Tudor Jones, Peter Lynch, Peter Schiff, Ray Dalio, Stanley Druckenmiller, Stephen Cohen, Warren Buffett, and maybe somebody else. So first of all, as I did mention before, no two investors are alike. We covered that before. So if you don't fit in this profile, it's highly unlikely. But remember, even if you do, you can be different. You can blaze your own path, your own trail. So first of all, the first investor legend we're going to analyze is Bill Ackman. You can see every single one we've put on this: time preference, analytical approach, focus, risk appetite. We'll go through these real fast because we have a lot to go through. But time preference is either short or long term. Analytical approach is either highly intuitive, like gut feel, or quant. You guys know who I would be on that scale. Then their focus, either broad or narrow. I tend to be more narrow. And risk appetite, risk averse versus very open to risk. I tend to be very open to risk. Now, this guy, Bill Ackman, his biggest trade showed his conviction of shorting a health supplement company called Herbalife. The ticker is HLF, arguing that the company was a pyramid scheme with an intrinsic value of 0. Ackman entered into a short position worth $1 billion in 2012. Now, I too like to identify companies that are kind of ghost companies, zombie companies, etc., and I don't mind going after them either. So it's very important to, know where you want to play, identify winners, and also you can make money identifying losers. just like Bill Ackman does very well. Next guy is Bill Gross. He is the bond king. This week, he just announced he bought Bitcoin. Now, for him to do that, that is a big eye-opener. I touched on it yesterday and the day before. But his approach is to follow mechanical signals to buy and sell, and then ride out the trend for as long as possible. But he stressed the need to follow your system, even when it showed a string of losses. Since his risk management meant that each losing trade cost him only 1% of his capital, he didn't mind risking 1% of his capital on each trade, and he was able to control his emotions to a greater extent than would have been the case if he had risked more. He also avoided making predictions, arguing that the market would tell him what to do if the time came. So again, like a mechanic, managing risk, very, very important. My background is financial risk management, and this guy does exactly that. I tend not to do such small conviction trades of 1%, but again, high frequency bond market's very different. And for him, who is typically a very risk-averse individual, to go out and buy Bitcoin, and a guy who's followed by every bond trader on earth, that is huge news. And you see a pattern as well of people, of these legends who are actually buying Bitcoin as well. Next one is Bill Lipschutz. His time preferences again between short, medium term. Analytical tends to be more of a quant guy, more of a narrow focus, and is open to risk. But he is a full-time foreign exchange trader. And for the bigger audience, he is known for making more than $300 million in 1 year just from trading Forex, which is really hard to do. So the only guy I know who's better than that is George Soros, who we'll cover later. Now, Bill Miller, another Bitcoiner, he is a legend in his own right. He managed Legg Mason Capital Management, and he beat the S&P 500 index for 15 consecutive years from 1991 to 2005. And that makes him a legend and very unique in this world. And he produced market-beating returns, you know, which is extremely unlikely based on the efficient market hypothesis. He's also right now, currently, this is the exciting piece, 50% Amazon, 50% Bitcoin. So, you know, a legend like that now have extreme conviction in two very distinct assets. Super interesting. Carl Icahn, he is an American financier. He has a holding company called Icahn Enterprises with a very diverse portfolio. But in the 80s, he was called a corporate raider. But in later years, he was more often labeled an activist investor. Again, legend in his own right. Did a lot with car companies and making them better by rating them. So Cathie Wood, I'm going to spend a bit of more time on her because she is, I believe she is the most underrated investor in the game today, and for good reason. Not only is she incredibly persuasive in her investment arguments, but she's also got the proven results to back up her surprisingly discerning claims. Now, her unique strategy regards unique investment philosophy only in disruption and innovation. And this is in part why she was able to identify things like Tesla early and make a fortune. But some people don't like her now. She's gone out of flavor because her assets are extremely risky. And in a risk-off environment, people sell her stuff first. But she plays the long game, like 3 to 5 years. But sometimes gets in and out of stuff very quickly, like Palantir. So when you look at her time preference, it will be mixed, a little bit different. Now, we'll get back to her in a minute, but we have a lot of other people to talk about first. So Chamath Palihapitiya, this guy is an interesting guy. He joined AOL back in the day, born in Sri Lanka, grew up in Canada, and he was the youngest ever vice president for AOL. And then he joined the Mayfield Fund. I know people that work there. And after that, he joined Facebook. Now, he was apparently a bully at Facebook. I don't know what that reads into in a personality type, but he left Facebook in about 2011 to start his own fund. He invested in things like Yammer, Slack, and Box, and made some good money there, especially on Slack, which was acquired. And he also told a Bitcoin conference in 2011 that he held about 100,000 Bitcoin. That cost him about $100 a pop. And in 2013, I think he told TechCrunch he would buy another $10 to $15 million in Bitcoin. And Bitcoin at that time was about $200, $300. So that was on top of the 5 million he already owned. So he now apparently has Bitcoin in trust. We don't know exactly how much he owns, but all roads lead to Bitcoin. You see the pattern here? Now, The reason he gets a little bit dinged in the study is he had a lot of SPAC investments in 2021, and the performance that he admits himself was just awful, absolutely horrendous. But it was also in things like Solana. He does not own all of Solana. He's not the only guy behind Solana. There's many of them, but that saved his bacon, as they say. So next guy is Dan Loeb. His preferred strategy is to buy troubled companies, replace inefficient management, and return the companies to profitability. And that's his key to success. And for you ladies and gentlemen out there, it's not hard to find companies with inefficient management, let's call it today. David Tepper. Tepper's strategy was simple: buy debt of companies on the brink of bankruptcy, but with conviction that these companies could claw their way out of bankruptcy. And when the junk bond market crashed in '89, some of you may remember that, Tepper bought a slew of distressed debt and made a fortune. I call this running into a burning building. And again, you see here, we're painting all the different ways you can be successful in investing. Now, next one is George Soros. Oh, George, love him or hate him. Some people don't like him. But he is famous, and he is a global macro strategy player. His philosophy is centered around making massive one-way bets on the movements of currency rates, commodity prices, stocks, bonds, derivatives, you name it, any other macro-based asset. He also made $1 billion a long time ago, taking down the Bank of England, the British pound sterling. And that's one of his many claims to fame. So this guy knows his stuff, and he's still active. And his fund actually owns Bitcoin as well. So Jack Bogle, he revolutionized the mutual fund world by creating index investing. And he's the guy behind, I can't even remember the name of the fund company. Completely miss it, but it'll come to me afterwards. It has a V in it or an M in it. Vanguard. He's the guy behind Vanguard. And yeah, that's him. So he took a process. That's what made him successful. Next guy, Jim Cramer. He has a TV show called Mad Money, and he recently said Ford is a better investment than Tesla. As I said, mad. I won't even go into his time preference, etc. But he also said some disparaging things about Cathie Wood. And I like people who are kind of consistent and stable. He called her a genius in 2021 and early in 2022. Actually, he called her a genius, and he said she has had one of the best investing runs he has ever seen in his life. And then all of a sudden, a few months later, when the ARK funds got hit hard, down 50%, now he wants you to short it. So again, mixed bag. Let's look at his time preference. He has a broad focus. He dabbles in everything. He's all over the place. Not very analytical, more intuitive, and time preference kind of middle of the road, and risk appetite middle of the road. So we'll see if that works later in the study. Jim Rogers, he encourages everybody, not only investors, to invest in gold and silver as a form of protection and insurance. You can see here he has a broad focus, quite intuitive, etc., etc. But he also says something, do not listen to any expert or listen to the internet. That's his most recent advice. Stay with what you know. So a couple of pearls of wisdom there as well. Jim Simons, this guy is pure quant. He exclusively uses quantitative analysis to decide which trades to enter based on market inefficiencies. Quant works, and Jim is very like us here. Purely quant, that's all we look at. And it works too. So Marc Lasry and his sister founded Avenue Capital Management in 1995 with $7 million, is now a $10 billion firm, and they focus on distressed and undervalued securities. And there's a lot of very undervalued securities out there right now as well today. So he's probably having a ball. Michael Burry. This guy is famous for shorting the 2007 mortgage bond market by swapping collateralized debt obligations, CDOs. And he now runs Scion Asset Management. Last year, he made a bunch of mistakes. He went short Tesla and a whole bunch of other things that were wrong. He was in way too many positions, both longs and shorts, all over the place. This year, his portfolio is much tighter, much smaller, much more focused, and he's not jumping in front of the Tesla freight train anymore. So we'll see. But again, great guy. Very interesting approach to investing as well. Paul Tudor Jones, one of the true legends. He also loves Bitcoin, coincidentally, and he attributes his success to a deep thirst for knowledge and strong risk management. Jones is a swing trader, a little bit like myself. He is a trend follower and a contrarian investor. He also likes to use Elliott wave principles. Now, most of his profits have been made picking tops and bottoms of the market, while often missing the meat in the middle. And Jones believes that price moves first and fundamentals second. And he is self-professed conservative, but I think he's a big risk taker. And I respect him and admire him. And his eyes, a good trader is someone who can deliver annual returns of 2 or 3 times their largest drawdown. So imagine your largest drawdown is minus 5%. You should be able to return 2 or 3 times that. Next guy, Peter Lynch, another legend. He's one of the most successful and well-known investors of all time. Also has a brilliant book called A Walk Down Wall Street. And Lynch is a legendary former manager of the Magellan Fund at Fidelity. And he took the fund over, I think, in 1977 at a very young age. He was about 30 and ran it for 13 years and was able to retire in 1990 in his 40s. Well done, Peter. Next guy, another Peter Schiff. He sells gold for Bitcoin on a site and also buys emerging market stocks. I'd love to know exactly how much gold he owns, but I know he owns a lot more equities on a Pomp interview. So next guy is Ray Dalio, another true legend. Dalio told many people that portfolio that doesn't have any systematic biases will produce an expected return that's comparable to good investments, which is very, very tricky when you dig into it. But he's come out with a lot of pearls of wisdom, and he's argued that it's even if you spend years studying markets, your knowledge will always be limited, and predicting the future is impossible. But he's managed to do very, very well. He manages probably the best hedge fund out there, and we'll see how he scores later too. Stanley Druckenmiller. He uses a top-down approach that combines long positions and short positions in all types of assets, stocks, bonds, currencies, futures, etc. And he made investment decisions based on the expectations for macroeconomic changes and market conditions within a relevant period. You begin to see here a little bit of a trend too, that some of these guys really focus on macro and they dabble in everything, both long and short. Now, Stephen Cohen, interesting fellow. He is the first, what I call a high-frequency trader of his time. He used to trade about 20 million shares a day. Sometimes he'd hold stocks for just minutes, not longer periods of time. And he has no belief in anything that is kind of old school. And he was truly a trader, and people frowned upon it, but he made it work. So he made money doing things that were typically against the grain of Wall Street. But most interesting, he believes 40% of a stock's price fluctuations are due to the market, 30% to the sector, and 30% to the stock itself. If you look at a little post I made earlier today, the news came out from the Fed meeting. Stock market fall, I said, within no time it's going to bounce again. And it did, just like that. So again, stock fluctuations are due to the market, not to the stock itself. Very important lesson. Next guy, last guy, Warren Buffett. This is very important. We can all take something from this guy. Again, love him or hate him, the guy is 91 years of age and still active. And I would love to be able to even be somewhat active. I don't know, a lot less than that. Anyway, his rules are simple, and I use many of them myself, and I've been following this guy for 30 years. Leaders must have integrity and a lot of talent. This is rule number 1. If you invest, I'm going to step out for this. If you invest in something, look at the leader. Do they have integrity or do they lie? If they lie, do not give their money to them. I'm not going to say what I'm talking about, but there's many people out there that are not honest. They do not have integrity, and sometimes not a lot of talent either. That's his rule number 1. And this guy knows what he's talking about. Number 2, invest by facts, not emotions. Same thing. I always say the same thing. Be a machine. And number 3, buy wonderful businesses, not cigar butts. Number 4, only buy stocks you understand or assets you understand. Same thing goes for crypto, ladies and gentlemen. If you don't understand the crypto you're investing in, don't touch it. Number 5, when you see a great opportunity, take it. You could say that about Bitcoin. He's not a Bitcoiner, but he's maybe a little old school for that. That's one of his only flaws. Number 6 is don't sell unless the business fundamentally changes. And he's a long-term investment guy. Look at Coca-Cola. He's been in for decades. And buy at a price below intrinsic value. Buy low, hold on. So that requires some fundamental analytical skills as well as we go forward. So that was the list of investors. This is a quick summary of all of the investors that we covered, and we profile them. This is a bit of an eye chart, but I want to show you how we looked at the data. And if you look at all of the scores, it includes both myers-briggs data and their legend score, their time preference, their analytical process and focus and risk appetite. You can't really pull much from that. But the key here is, the big thing that fell out for me is 17 out of the 23, 24 we analyzed had an N for an attribute, an N for his intuitiveness. That was a key thing that falls out of that. But we're going to show you how we pull this data apart. Let's look at the correlations that we uncovered from looking at this data. First of all, from their personality types, 43% are extroverts, 57% introverts. Okay, so it's kind of like even Steven, doesn't really matter. In terms of the S or N, the sensors versus the intuitives, you'll see 26% were sensors, 74% intuitives. Now, this is where it really got interesting. 100% of these legends, or these people, were all thinkers. Feelers, 0%. We'll talk more about that later. Judgers were 65% and perceivers were 35%. We'll also talk about that later. But let's dig more into their historical results and how they get categorized in our framework. So first of all, the investor style findings. We have created a 16-point scoring mechanism that we're going to use for the community as well. And we're going to try build bespoke playbooks as to how people should trade and invest based on where they fall in this map, just as a guide. And an important caveat is not every investor fits perfectly into each of these styles, but rather they represent the closest fits. So you have people like Cathie Wood. She's LQNT. She's a long-term investor to a large extent. She focuses on quant, etc. Warren Buffett, LQNA, similar to Cathie Wood. Bill Gross, SQNA, more short-term. Jim Simons, short-term. David Tepper, short-term, etc. So we covered this in the part 1 video as to how all these play out. But again, it's important as we dig deeper in part 3 where you guys fit and the playbook for investing you will need based on where you fit in this box. The next part is the archetypes. We have categorized 4 major buckets, not as granular as the previous slide, but here we have our farmers, which are risk averse and long-term driven. That includes Warren Buffett, Jack Bogle, Ray Dalio, and Peter Schiff. Then you have your daredevils, your George Soros, Paul Tudor Jones, Marc Lasry, Stephen Cohen. These are risk-loving, intuition-driven people. The intuition there, remember that word, that's very important for later. Then we have the explorers and trailblazers. They are risk-loving, quant-driven. Very important. Cathie Woods, Jim Simons, Stanley Druckenmiller, David Tepper, quant. And then we have the surgeon snipers who are risk-averse, but calculate their risk. They're heavy into risk management. It's Bill Ackman, Bill Gross, Dan Loeb, and Carl Icahn. So they are the 4 big archetypes. So first is identify where you play here, and then look at how these legends actually invest. Now let's look at the correlations. This was probably the biggest standout moment for us, not only the correlations, but the R-squared for all of these different types of legends. And we were trying to see if there is a correlation between those legends who are very analytical and very successful. And we created a score called a legend composite where we analyzed all of their factors, all of their results, all of their investor returns over their entire lifespan. And what's so stunning from this is the correlation is 62% and the R-squared is 0.437. So basically, this is one of the most important factors. If you do your homework and if you're highly analytical, you will be a good investor. So I was very happy to see this because highly analytical is my core competency. Second, most important of all factors is focus. We want to see if there's a match between the amount of focus these investors have and their legend competence score. And again, yes, the correlation was 47.52% and the R-squared is 0.226. So 2 for 2 so far. Let's go a little bit further. Let's look at the time preference. Now for us, the relationship between time and our legend composite score, the correlation is 46% and the R-squared is 0.182. So yes, the longer your time series, the more success you will have. It's extremely difficult to invest hour to hour, day to day. But the longer you have, 3, 6 months, 12 months, 2 years, the better you can manage your risk and the better your returns will be as well. Now, finally, risk preference. So I'll step out for a second. I would have thought, typically, historically, the more risk you take, the more return you get, but also the easier you can blow up your whole bag, as it were. This is an interesting factor. The risk preference relationship to our legend composite score correlation is 25%, and the R squared is 0.065. This surprised me because I thought that most of these legends would take on a huge amount of risk to get a huge amount of gains, like people like George Soros. But on average, there are people that are highly risk averse and they manage risk impeccably well, and therefore they also get very good returns. And this shows you the importance of risk management, which is probably my second core competency out there too. So let's rank these success drivers. 1, analytics is the most important. 2, be focused. Do not invest in 20 different things, 10 different things even. 3, time preference for longer time frames, very important. And 4, risk. The more risk, the more return in most cases, but not all cases. There are exceptions to this rule as well. Now, let's look at correlations, personality types, and winning and see what we can pull out here. So the big takeaway here is when you look at the legends, the top legends, the people with the highest performance over time, and time is very important. If you're successful for 70 years, that beats somebody who's successful for 7 years by a big factor. So you got Bill Miller, George Soros, Warren Buffett, Peter Lynch, Stanley Druckenmiller, Ray Dalio, and Paul Tudor Jones. You'll notice all of them have N, T, and J for the most part, with the exception of Warren Buffett, and Ray Dalio has a P. That is huge. So if you have N or T or NT or J, these are critical factors, and most of the top investor legends have them as well. So let's look at the results from the community here and see what we can pull out from that and see how it maps to these legends as well as we go forward, if there is a match, and see what you guys are like on average. Now, you all still have a chance to do the profile. We'll leave a link below for the survey. So we plan to close it out next week, and we'll share our detailed findings in part 3 with that bespoke playbook to help guide you if you are a certain type, what you should be investing in, what time frame, what type of focus. Should you be analytical? And if not, how can you shore that up if you're not an analytical person, etc. So that's all going to come. So remember, if you still want to hit the study, please do so. Now the demographics so far, up to this moment in time, we have 3,000 respondents. We only crunched the numbers for about 2,700. 87% male, 13% female. 57% from North America, 28% Europe, 10% Asia Pac, and the other 6% Asia, South America, Africa. So interesting mix, and it's pretty representative of the audience of the channel. Now, this was super interesting. When we look at the community, first of all, it's a heavily introverted community, and NTJ is very, very common, which means the people with an NTJ focus have a much higher weighting based on communities, and it tells us that these are investors, and they're very interested in investing, and they're also good at it. We're going to break this down further and correspond it to, mankind on Earth and how those shake up and how the profile exists. But one thing we can say for sure is the T, J, and the N are extremely high, and the I for introvert is extremely high, and that is not normal. So again, from over 2,700 respondents. Second of all, if you look, not only are the majority introverted, but it's interesting is many are very, very focused and analytical, and extroverts take the most risk, and our community is heavily introverted. So if you look at time preference, it looks like you guys are medium to long-term investors, which is good. Highly analytical, which is good. It's probably why you look at the math channel, which is Invest Answers. And you tend to be very focused. But the big takeaway here is you're quite risk averse, which is also very good. So it means you're not dabbling in things like Dogecoin and the like, and Hex and all that good stuff. So this was super interesting for us as well to see. Now, next, the male versus female difference. This was also very interesting. And again, we're just scratching on the surface of the data that we have now. And it's all anonymous, so don't worry. Nothing is shared. But according to the data, women in the community are much more patient than the men. The men are slightly more analytic, And this is just per the 2,740 people we analyzed. And the men focused on fewer assets and also have more risk appetite, but it's not far off. So hopefully we can urge more women to take the survey because there's only 13%. Now, where you guys all fall on average is really interesting as well. The IA community, on average, is between a Ray Dalio and a Warren Buffett, and that is super impressive. That's where I would want to be if I could. I'd probably be a little bit up more towards Cathie Wood, perhaps, or between Cathie Wood, Stanley Druckenmiller, Ray, and Warren. That's the quadrant you want to be in. And our community is long-term focused, risk-averse, slightly quant, and investing kind of with more of a focused lens as we go forward. So really good. Again, first scratch at the surface. We'll be digging a lot deeper into this as well. Now, the best prototype archetype fit for the community, they are farmers, risk-averse and long-term driven. So congratulations to the yeehaw farmers out there. But again, we also take some risks. You know, investing in disruption like Tesla is a risk. And I know you guys have a lot of Tesla there too. Again, first stab, we're going to be digging a lot more into this. Now, part 3. There's so much more to unpack with what we have. We'll build out more profiles, more findings, and that playbook that you should need to follow depending on who you are. So this will be patterns between risk and time and income and net worth and age, where you need to fit, how you should play, how risk averse you should be, what type preference you should look at, etc. So super interesting stuff coming. And conclusion, everybody. I'm going to drink some tea before I go. So first of all, these results are preliminary, and they may change if we get more data. Second, backing into our early 2021 thesis, this was the conclusion that we made in March 1st, 2021, when I had like 20,000 subscribers or 10,000 subscribers. I don't even know what it was. But basically it was INTJs, the best investors. And the answer is, wow, from this study, I and E, not really important, but the NTJ is very important if you have it. Now, there is hope. If you don't find yourself in the NTJ category, all is not lost. There are ways to make money, and there is ways to structure yourself to be successful in this game. So first of all, N, T, and J are key to success. But remember, all top investors seem to be very intuitive. They find patterns in things. They rely on their intuition to make decisions, and they are very good at decision making. The S is for sensing, and they rely on it, and they rely on what's done in the past. So the big lesson here is top investors are intuitive, find patterns, and rely on intuition. T is a thinker. They rely on their heads to make decisions, core logic, etc. J are judgers. People feel more comfortable when decisions are made. They tend to plan ahead and work first. But remember, whether you're introverted or extroverted, that doesn't matter. Investing is technically a private activity. But the big thing here is it all goes back to, well, we'll jump in and explain why these things are different. First of all, as I mentioned, good news. It doesn't really matter if you're introverted or extroverted. It doesn't matter to your success of investing. Second, this is the piece that we need to drill into. 74% of the best investors of the legends we analyzed are intuitive. Now, intuitives focus on what is possible. They see patterns and they value innovation and solve problems. The sensors focus on facts and details and look to the past to come up with a practical solution. And they're often trapped by scar tissue. If they ever lost money in the past or got stung in the past, that prevents them from moving forward. And this is what we need to kind of get away from. And the key is to unleash the past. Forget the scar tissue. I know scores and scores of extremely intelligent people, massively IQ off the charts, but they have this scar tissue and they have the inability to take on any type of risk because of something that happened to them in the past. So the big lesson here is if you do have that scar tissue, forget about it and move on. Look at patterns. Imagine what's possible. Solve problems. That's very, very important. Now, feelers versus thinkers. We know the thinkers generally err on the side of emotional detachment. I always say be the machine. Now, feelers default towards emotional investment. And I've said this 1,000 times to you all. 100% of good investors we analyzed are thinkers. Okay, so it's very, very important. Detach yourself from any emotion. Save your emotion for your family and your friends and your hobbies, but be a machine when you invest. Okay, it can be hard to detach, but you can train yourself to do this, and I know that for a fact. Next one, investing. Judgers versus perceivers. Judgers, again, are typically the best investors, and if you are a perceiver, be aware you are a perceiver and think about these steps. So, and you know who you are when you hear this. So judgers, they're outwardly organized and orderly and enjoy established plans. Very important for investing. The perceivers prefer to keep options open, spontaneous, enjoy flexibility, and investing, there's no room for this. You can't be willy-nilly. You need to set a goal, build a plan, execute it. Again, no emotion. If you don't have that plan, you will not be successful. So again, take that. We're gonna flesh all this out in greater detail in part 3 as well as we go forward. So that was it, everybody. I don't know how long I've been talking, but let me see. Here I am, 36 minutes. That was a lot of material to get across. So again, hope you guys like it. We're working on part 3. We're going to take all your detail, build those bespoke playbooks, and help guide you through these shark-infested waters. And in other good news, Bitcoin's up 5% above 41,000. Big day, as we said yesterday. It was only a matter of time before the breakout. It was imminent, and here we are. So fingers crossed. Be safe, everybody. Thank you for all the comments. Thank you to the moderators in the chat and everybody else who donates. See you all soon. Bye.